Jim Frias with IQ Sense. Hope all is well. Today, over a cup of coffee, we are going to discuss the latest bank failures and find out what it means for your investment portfolio. The sudden collapse of two major banks have caused the Fed to pivot from its aggressive Fed rate policy to possibly future cuts sooner than later. Now, let's find out what all this means, piece it together. So, take a moment, pour yourself a nice cup of coffee, and let's increase that financial IQ.
Once again, financial markets have been rattled by the sudden collapse of regional bank Silicon Valley Bank, which was the second largest bank failure in the U.S. history. Fear spread, and a few days later, Signature Bank was taken control by the U.S. government that resulted in the third largest bank failure in U.S. history. The collapse of both banks immediately brought memories of the great financial crisis of 2008. The fear spread quickly to Europe. Credit Suisse, a large bank in Switzerland, also collapsed. To add some insight on that, Credit Suisse balance sheet accounts for roughly 70% of Switzerland's GDP, which is roughly about $800 billion last year. That huge size relative to Swiss GDP prompted the Swiss government to force a takeover by its rival UBS in order to stabilize the Swiss banking system or to avoid any wider spillovers of the economy. The Federal Reserve Chairman Powell rattled financial markets in early March when it hinted of more aggressive rate hikes and rates would stay higher than previously projected. However, the latest bank failures and the fear of contagion has had the Federal Reserve change its tone in its latest rate hike. Further, on March 22nd, the Federal Reserve raised the interest rate by 0.25%, which was highly anticipated according to the popular Fed Watch tool the CME Group created. The Federal Reserve removed the verbiage of ongoing increases. That departure is an indication that the Fed is near its rate hike cycle. It also addressed the recent events are more likely to result in tightening credit conditions, which will ultimately weigh in on the economy as it slows down.
And when President Trump passed that bill and raised the threshold from, I think it was 50 to 250, now I think that was bad. I think Elizabeth Warren has a real valid point about it. But we looked at the stress test for last year. And the stress test for last year had about a line in it about rising rates. And the rest of the entire stress test was about credit. So even if Silicon Valley had been in the stress test, given what the stress test says, I don't think the regulators would have caught it.
They would have passed it.
And, you know, the stress test is basically fighting the last battle. That battle has been won in the large banks. They're better capitalized. Their risk, even with that capital, is much narrower. You know, as Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. Credit quality in the United States is really good. This is a tide of a mistake, which is some of the regional banks, especially those that have a lot of deposits above 250, bought long-term bonds at very, very low levels and have massive mark-to-market losses. That's why Silicon Valley failed. Also, they failed because they had a very, very concentrated type of deposit base, which has a very big herd mentality.
The latest bank failure should detract you from your investment plan. Every time when the financial markets have experienced severe market volatility, it was due to the lack of having factors that can attribute to something measurable in the past. All economic crises that have led to major stock market declines have had unique factors. Financial professionals typically describe this period by saying, "I have never seen this before," or "this is a whole new ball game." In reality, there has always been a reason not to invest, whether it's war, economic recession, or political crisis. You shouldn't change your investment plan unless your financial goals have changed. Every investment plan should have an action plan on how to weather market volatility. Here are 5 steps that will help you manage the times of uncertainty.